Okay, let's unpack this. Welcome back to the Deep Dive. This is the show where we take some of the densest source material you can find, actuarial tables, policy fine print, you name it, and we really try to distill it down into essential knowledge.
Yeah, and today we are tackling a big one. It's a cornerstone of personal finance, something that's often misunderstood, I think. People just hear life insurance and think it's this one single kind of dull thing.
A monolith.
Exactly.
Yeah.
But it's a huge spectrum. So for this deep dive, we're going to focus entirely on one critical slice of that spectrum.
And that is term life insurance.
Term life insurance, or as you might sometimes hear it called, term assurance. And our goal here is to really move you past those surface level definitions. We want to get into the mechanics, the strategy, what really makes this product tick.
Right. So our mission for you is to gain a comprehensive but not overwhelming understanding of term life. We're going to look at its architecture, the specific math behind the premiums, which is fascinating.
It really is.
Its key uses, and some really crucial features like conversion rates. This isn't just a summary. We're trying to shortcut weeks of research to get you truly well-informed.
So let's start at the very core, the definition. At its heart, term life is, beautifully straightforward.
It is, isn't it?
It's an insurance product that gives you a specified amount of coverage, a death benefit, at a fixed payment rate. But, and this is the key, only for a limited defined period.
A term. And the most important defining characteristic, the absolute deal breaker.
The payout condition. The death benefit is only paid to your beneficiary if the insured person dies during that specific active term.
So if the policy ends on Tuesday,
and you pass away on Wednesday, there is no payout. The protection ends precisely when the term ends. It's a hard stop.
and that immediately sets up the big contrast, the main comparison point, which is permanent life insurance.
Right. When we talk about permanent products, things like whole life, universal life, variable universal life, you're talking about a whole different animal.
Because with those, you are essentially guaranteeing coverage for the entire lifetime of the insured.
Provided, of course, that the policy stays funded and doesn't lapse. But yes, the intent is lifetime coverage.
And that fundamental difference in duration, it dictates everything about the cost structure, doesn't it?
It's the whole ballgame. Term insurance is almost always going to be the least expensive way to buy a substantial death benefit per premium dollar, but only over a specific period. You're just paying for the pure mortality risk, the pure chance of death during that set window of time.
Right. So term life is pure risk mitigation. It's designed for pure income replacement.
Exactly. This is not the primary tool you'd use for, complicated long-term wealth transfer strategies. We're not talking about advanced estate planning or funding a huge charitable trust that might exist 50 years from now.
Its context is much more immediate.
Entirely. It's focused on those years when your financial responsibilities are at their absolute peak. Think about a family with young children or someone who's just taken on a massive 30-year mortgage.
Yeah.
Term life is meant to cover those critical obligations. Paying off the house, replacing a lost salary so your family can maintain their lifestyle, covering years of childcare.
University education.
University education, absolutely. And even just making sure basic final expenses are met without causing a financial crisis.
I really like the analogy that was in the sources, that it functions just like your car or home insurance.
It's a perfect parallel. You pay a premium to transfer a catastrophic risk, a car crash, a house fire, to an insurance company for a set period, usually a year.
And if you don't total your car or your house doesn't burn down, you don't get a refund at the end of the year.
Not a penny. And that's a critical sort of psychological hurdle for some people to get over, but it's an essential financial truth for you to understand. You are buying peace of mind against a specific uncertainty.
And if that risk doesn't happen,
you successfully use the product, you paid for protection against a risk that never materialized during that covered period, you don't get those premium dollars back.
Excellent. Okay, that sets the stage perfectly. So our deep dive now moves into the specifics, right? Starting with the foundational structure and the strategic reasons people choose this type of coverage in the first place.
Let's do it.
As we move from, the what into the how, that cost advantage is the immediate motivator.
It has to be. Even for someone who might be considered a higher risk, let's say an everyday smoker term insurance offers a significantly lower barrier to entry for a large amount of coverage compared to any permanent product.
Mm-hmm.
The cost difference can be staggering.
Depending, of course, on how long the term is.
Of course.
Yeah.
The length of the term is a huge factor.
Yeah.
But yes, that affordability is what makes this common strategy possible. what's often called the retirement philosophy.
Okay, let's talk about that. How does that strategy actually play out for someone who's buying a term policy today?
The core idea is all about becoming self-sufficient. So an individual, maybe they're 35, they get a policy, let's say a 30-year term, that's specifically designed to expire right when they anticipate their major financial responsibilities will end.
So around retirement age, like 65?
Exactly. The goal isn't to hold on to insurance forever.
Okay, so the premise is that by the time you retire, you've built up your own safety net.
That's it, precisely.
Yeah.
The idea is that by age 65, you will have accumulated enough personal capital, your house is paid off, you have substantial balances in your retirement accounts, your 401ks and IRAs, other investments, that you've effectively become your own insurer.
I see. So if you were to pass away at, say, 68, your accumulated savings are what provide that financial security for your dependents.
Correct. The external insurance policy becomes redundant. It's unnecessary because your own risk can do the job. It's a very purposeful phasing out of risk transfer.
That makes incredible sense. You're ensuring your human capital, your ability to earn an income during the decades when that capital is most critical.
And then you let your accumulated financial capital take over later on.
Right. But to understand how those long level-term policies are even priced, we have to start with the simplest, purest form of the coverage.
We have to. And that is annual renewable term, or ARTER. It's the analytical foundation for everything else we're going to talk about. It is the absolute simplest structure, a term of exactly 1 year. The benefit is paid only if death occurs within that 365-day period.
And because that risk period is so short, especially for a young person, the premium calculation is equally simple.
Dead simple. It's based purely on the expected probability of you dying in that single year. For a healthy 30-year-old, that mortality rate is incredibly low, which makes the coverage very, very cheap.
Initially.
Initially, that's the key word.
It is, because while it's analytically pure, just buying a single year of art is pretty rare in practice. It introduces this huge hurdle of insurability when it comes time to renew.
Let's elaborate on that. Why is proving your insurability every year such a massive threat in that environment?
Okay, so the problem comes up when you need to renew for the next year. If the policy says you have to prove you're still healthy every single time you renew, which a basic single-year term policy would, you risk losing your coverage right when you need it most.
Give us an example. Imagine a 40-year-old takes out coverage. 6 months later, they get diagnosed with a severe, chronic, or even terminal condition, but they don't actually pass away before that year is up.
So they survived the policy period, but now their health status has just plummeted.
Exactly. They are now highly, highly unlikely to pass underwriting for a new policy. And even if they could find a company that would cover them, the premiums would be astronomical. The insurer essentially got to offload the risk before the claim happens.
So the solution to this pretty fatal flaw in the basic RT structure is building in a guarantee.
You have to. And that's guaranteed reinsurability.
Okay.
It's the feature that transformed RT from a theoretical concept into a viable long-term product. This feature allows you to renew the policy each year without providing new proof of insurability.
So it addresses that primary risk that your health could change and make future coverage impossible to get.
It solves that exact problem. And this brings us to the structure of RT as it's commonly purchased today. We're talking about a policy that guarantees you can continue it for a long time, 10, 20, 30 years, sometimes even all the way until you reach age 95.
But, and this is a huge but while the right to renew is guaranteed, the cost is not.
And that's the crucial detail. This common RT policy dictates that your premiums increase with each renewal period. As you get older, your likelihood of mortality rises, and it actually rises exponentially. The premium just follows that curve upward.
And at some point, that curve just becomes completely unsustainable.
Totally. The yearly rate increases eventually become financially inviable. I mean, the rates for a 75-year-old on an RT policy will typically be far, far higher than the cost of even an expensive permanent policy. Most people are forced to abandon it long before they reach that maximum renewal age.
So that slight increase in premium you pay up front, compared to a truly non-renewable single-year policy, that's what's buying you that critical guaranteed renewal right.
That's what you're paying for. The company is baking in the cost of having to guarantee coverage to someone who might get diagnosed with a terminal illness 5 or 10 years down the road. And this whole concept, this annually increasing pure mortality cost, is absolutely fundamental to understanding what we're talking about next.
Right, because since RT shows us that true rising annual cost of risk, we can now appreciate the financial engineering that goes into the product most people actually buy,
Guaranteed level premium term life insurance.
which manages to package all that increasing risk into one single predictable payment.
And level term is defined by that promise. The premium is guaranteed to remain exactly the same level for the entire contract. The market standards are, 10, 15, 20, and 30 years.
This is the moment for the deep dive listener. We have to explain the pricing mechanic. How on earth can an insurer guarantee you a fixed rate for 30 years when we both know the cost of insuring you in year 30 is exponentially higher than it is in year 1?
It's not magic, it's actuarial science. And it's based on two key factors: averaging the risk and the time value of money.
Okay.
The level premium is calculated by essentially summing up the anticipated mortality cost, that RT rate we just talked about, for every single year in that 30-year term.
So they're taking the total projected cost of insuring you from, say, age 40 all the way to age 70?
Precisely. They add all that up. Then they divide that total sum by the number of years to find a rough average. But then they make a critical adjustment. They factor in the time value of money, or TVM.
Let's focus on that TVM component. This is where the insurer makes or loses their money.
This is the whole engine. In the early years of, say, a 30-year policy, the premium you're paying is significantly higher than the actual pure cost to insure you for that specific year.
You're overpaying.
You're front-loading the cost.
Yeah.
And that difference, that overpayment, goes into the policy's reserve account. And that reserve account is then invested by the insurance company.
And the power of compounding interest is doing the heavy lifting for them over decades.
It's the invisible force in the contract. The insurer needs that early overpayment because that money has to earn compound interest for 20 or 30 years. And that accumulated capital, boosted by their investment returns, is what they use to offset the dramatically higher mortality costs in the later years.
I mean, the cost of insuring a healthy 65-year-old might be 50 times the cost of insuring a 35-year-old.
Easily. So those reserves built up from the early overpayments are absolutely mandatory to neutralize that spiking risk curve and keep your premium level.
And that immediately clarifies why a 30-year term policy is always so much more expensive right at the start than a 10-year term policy for the same person, even if they're young and healthy.
Of course, because that 30-year contract forces the insurer to average in those extremely expensive mortality years when you're in your 60s and 70s and the risk is highest. They have to collect more premium from you today to build up sufficient reserves to cover that liability 25 years from now. They're taking on a much longer and more expensive guaranteed risk.
Now, when that term finally does expire, level term policies don't just, vanish into thin air, do they? What are the standard renewal options?
No, they don't just disappear. Most level term contracts will build in a renewal option that kicks in automatically at the end of that guaranteed level period.
So you can keep the coverage?
You can extend it, often on an annual basis, but it's at a maximum guaranteed rate. And that guaranteed rate is now calculated year by year, just like the RT structure. So it's going to be significantly higher than the level premium you were used to paying.
And you have to check the contract, but renewal is typically guaranteed without needing new proof of insurability.
Generally, yes. Which brings us to the feature that is, I think, the most valuable potential emergency exit for a policyholder. And that's the crucial conversion feature.
I really want to spend some time on this because its value is so often underestimated.
It is probably the single most valuable rider on a term policy, especially for long-term planning. The conversion right is a contractual provision. It allows you, the policy owner, to switch your term coverage into a permanent life insurance product, usually a universal life or whole life policy offered by that same carrier.
And why is that such a powerful tool? What's the magic trick here?
The magic is the principle of retention of rating class.
Okay.
Let's use a real-world scenario. A young professional buys a 20-year term policy at age 35. They're in great health, non-smoker, and they qualify for preferred best, the absolute best rate class you can get.
The lowest premium.
The absolute lowest. Then at age 50, 15 years into the policy, they get diagnosed with type 2 diabetes or maybe early-stage Parkinson's disease.
So if they tried to get new coverage at age 50, they'd be immediately classified as standard or maybe even substandard risk. They'd face drastically higher premiums if they could even get insured at all.
Exactly. But if they use their conversion right before the deadline, the new permanent policy they get is issued at the rate class of the original term policy.
So they get to keep that preferred best rating.
They retain the underwriting decision that was made 15 years earlier. It preserves that low-risk status, regardless of their current health. It's an absolute safeguard against the financial consequences of becoming uninsurable.
That is a phenomenal safety net. But the sources do caution us that this right has very specific conversion limitations. We need to detail those for the listener.
Oh, this is absolutely critical. First, that right to convert almost never extends to the very end of the term. A 30-year term policy might only allow you to convert during the first 20 years.
Or it could be tied to age.
Right. Sometimes the conversion right just terminates at a specific age, like 70 or 75.
Yeah.
If you miss that deadline, the right is gone forever.
And the second point is the cost reality of converting. Just because you get to convert at your original favorable rate class, that doesn't mean the premium for the new permanent policy is going to be cheap.
And that is a harsh financial reality that you have to plan for. If you convert a policy when you're 65 years old, even with a preferred best rating, the cost of permanent insurance, whole life or universal life, is still extremely high.
Because you're still 65.
You're still 65.
Yeah.
The conversion preserves your rate class, but it can't override the fundamental mortality cost associated with advanced age. A policy converted at age 70, even at the best health class, will often be prohibitively expensive to maintain. Sometimes you have to reduce the death benefit amount just to make the premium manageable.
We've set up the structure of term life. Now let's really go behind the curtain. We're heading into the actuarial engine room.
I like that.
This section is key because understanding these three universal assumptions explains every single quote you will ever receive for any type of individual life insurance.
And what's so fascinating here is the uniformity. Term, whole life, universal life, they're all built on these same three pillars of calculation. Let's start with the big one, mortality.
Mortality risk. This is the fundamental calculation, right? Using a huge sample size, how many people are expected to die in a given year at a given age?
That's it. And to establish this, actuaries use recognized benchmarks. Now, we need to clarify a common misconception from our sources. The benchmarks are typically the commissioner's standard ordinary mortality tables, or CSO tables.
Okay, so these are developed by professional bodies like the Society of Actuaries, not a government agency.
Exactly. The CSO table is a benchmark for solvency and reserving requirements. It represents the projected mortality of the general insured population in the U.S.
So it's the baseline.
It's the baseline. But, and this is important, insurance companies don't just rely on the CSO tables. They use their own proprietary data. We call it their corporate mortality experience.
And why is that proprietary data almost always more favorable, meaning fewer deaths, than the general CSO table?
It's because of the underwriting filter. The CSO table is broad. A life insurance company subjects you, the applicant, to rigorous underwriting medical exams, blood work, checking your prescription history.
They filter out the highest risks.
They filter them out. The result is a pool of policyholders who are demonstrably healthier than the general population. So, a company's projected death rate for its own customers is significantly lower than that public benchmark. And that lower corporate mortality rate is often a company's biggest competitive advantage.
That makes perfect sense. They have a healthier pool of people so they can charge less. But that corporate rate is then refined even further by the underwriting process, which slots you into a specific health classification.
Yes, this is the next layer. That medical exam and questionnaire determines your risk class, which acts as a multiplier against that base corporate mortality cost. The standard classes are usually things like preferred best,
Which is excellent health, clean family history, non-smoker, the absolute lowest rate.
the best you can get. Then you have preferred, which is very good health, maybe some minor manageable issues. Then standard, which is just average health for your age group.
And then below that, you have substandard.
Substandard, or table ratings. This is for people with known health issues like controlled type 2 diabetes or a heart condition. They receive a table rating, which just means their premium is the standard rate plus a percentage. So table 4 might mean standard plus 100%.
So two 35-year-olds could get wildly different quotes if one is preferred best and the other is substandard, even if the underlying actuarial math is similar.
Absolutely. That classification is the direct driver of the premium multiple. It's the gatekeeper.
Okay, let's move to the second pillar, which connects right back to our discussion on level term, and that's the assumed net investment return.
This is the yield the company expects to earn on the billions of dollars it holds in reserve. You know, the premiums you and everyone else pays.
This assumption is so critical. If a company assumes it can earn, say, 5.5% annually on its investment portfolio, which is around the current industry average, they need to collect less premium from you today to meet that future death benefit liability.
Because the investment returns are expected to cover a portion of the future cost.
So what happens if the company aims too high? Or if interest rates just plummet for decades?
This is a huge financial stress point. I mean, the historical context here is fascinating. In the early 1980s, when interest rates were through the roof, some policies were priced using return assumptions of over 10%, sustained for the life of the policy.
Wow.
Now imagine a modern company trying to price that same 30-year policy. If they have to use a 5.5% return assumption instead of a 10% one, the required premiums have to be dramatically higher just to satisfy solvency rules and ensure that future liability is covered.
And this explains that rare, complex scenario we saw in the sources, where some companies have had to raise mortality costs on existing permanent policies.
That's exactly why. If their investment returns seriously underperform for a long time, the company might have to adjust the one component they can control on existing policies, which is the internal cost of insurance or mortality. They do it to legally bridge that solvency gap. It really shows you the deep connection between global financial markets and your personal policy premium.
Okay, finally, the third pillar, internal administrative expenses.
The cost of keeping the lights on. It's primarily driven by two proprietary figures. First, you've got policy acquisition costs.
This is mainly sales commissions to agents and brokers.
Right. Often substantial commissions paid up front, which are then amortized over the life of the policy.
And second is just general overhead.
Yep. General home office expenses, salaries for actuaries and underwriters, infrastructure, claims processing, regulatory compliance costs. For you as a term buyer, the goal is always the max death benefit for the lowest possible premium. And since term policies don't have those complex cash value mechanisms, the administrative burden should, in theory, be lower than for permanent plans.
So given that all companies are using CSO tables as a baseline and their investment return targets are sort of constrained by market reality, is it fair to say that the real competitive edge in the term market often boils down to the efficiency of their administrative expenses and how accurate their proprietary corporate mortality data is?
That's the synthesis you need to take away. Because those three universal components are shared, the premium range for the exact same coverage between major carriers is surprisingly narrow. Small optimizations in corporate mortality, maybe they're just better at underwriting a specific demographic or lower admin costs due to better technology, can shave those few dollars off the premium. It makes the market incredibly competitive and very price sensitive.
Let's pivot now to some more specialized structures, starting with a product that taps directly into consumer psychology.
Ah, yes. Return Premium Term Life Insurance, or RPT.
RPT.
This is a classic hybrid product. It's designed for the person who just hates the use-it-or-lose-it nature of traditional term insurance. The mechanism is simple. If you outlive the policy term, the company returns a majority of the premiums you paid.
Usually minus some fees and expenses.
Right, but you get most of it back.
That sounds fantastic on paper. Why doesn't everybody buy this?
Because there's a very big catch. The premiums for RPT are dramatically higher. I mean, often 150 to 300% much higher than for a comparable regular level term policy.
I have to challenge this from a critical perspective. If the premium is that much higher, is this really a good financial product? Or is it more of a sophisticated sales technique that's just designed to appeal to that psychological need for a refund?
I think it's largely the latter. Financially, what's happening is the insurer is using the difference between the RPT premium and the standard level term premium as an interest-free loan from you, the policyholder, for the entire duration.
They invest your extra money for 20 or 30 years.
Keep all the investment earnings and then just return your principal at the end.
Let's illustrate the opportunity cost for you, the listener. Let's say a standard 20-year term policy costs you $500 a year, but the RPT version costs $1,500 a year. That's a difference of $1,000 annually.
Right. Over 20 years, you've paid an extra $20,000. Now, if a disciplined investor takes that $1,000 annual difference and invests it consistently, they would only need to earn a pretty moderate compound annual growth rate, often below 5%, to end up with more than the $30,000 in premiums they would get back from the RPT carrier.
And they had the same death benefit protection the whole time.
The exact same protection.
Okay.
So the guaranteed return from the RPT is often diminished substantially by 20 years of inflation eating away at its value.
So RPT is really appealing because that return is guaranteed, but a disciplined investor will likely achieve a far better outcome by just buying standard term and investing the premium savings themselves.
That's the critical takeaway. RPT is a psychological comfort product. It is generally not a tool for maximizing your financial efficiency.
Okay, let's move to the direct cost difference. Term versus permanent. We said both use the same underlying mortality tables, so why is term insurance so much cheaper for younger people?
It all comes back to the limited time horizon. A 35-year-old buying a 20-year term policy has a statistically remote chance of dying before they turn 55. The cost of insurance is low simply because the risk of the company having to pay out is very, very low during that specific window.
Contrast that with the permanent policy strategy, which has to build up a cash value.
Right. A permanent policy, by its very design, assumes a 100% certainty of a payout eventually. So to afford that inevitable liability, the policy owner has to contribute a premium that is substantially more than the pure cost of insurance during those younger, lower-risk years.
And that extra money becomes the cash value.
Correct. The cash value buildup is essentially a mandatory savings mechanism inside the policy. Those funds and the returns they generate are what's crucial to offset the dramatically higher, often exponential cost of insurance that kicks in when the insured person reaches their 80s and 90s. The cash value is the internal mechanism ensuring the policy stays solvent until that inevitable death claim.
Now, for a really critical caveat about products that can blur this line, let's talk about the universal life caveat, the risk of what some call term for life policies.
This is a complex area, especially with what we call leanly funded universal life or UL policies. These are often designed for the absolute minimum premium. They offer a guaranteed death benefit, maybe up to age 90 or 95, but they often accumulate very little internal cash value.
So they act like a term policy that just happens to have a very long duration.
In a way, yes. And the specific risk of lapse for the insured here is significant. If the underlying cost of insurance rises faster than the cash value is growing, or if the investment return inside the policy underperforms, the policy can literally run out of money.
And the guarantee is only good as long as there's money to pay the bills.
The insurer guarantees the death benefit only as long as the cash value can cover the internal costs. If the contract expires and the insured is still living, let's say you're 96 and the guarantee ended at 95, the policy ends without value. You've paid premiums for decades and you're left with no coverage and no cash.
It really highlights the need for careful funding and regular monitoring of UL products. And finally, let's address a point of major confusion for policyholders: cash value retention when someone dies.
This is non-negotiable across almost all cash value policies, whether it's whole life or UL. If you, the insured person, die, and the policy has accumulated cash value, the insurance company retains that cash value. They only pay out the stated death benefit face amount that's listed on the policy.
So the beneficiaries do not receive both the face amount and the accumulated cash. Why is that?
Because the cash value was never intended as an extra payout. It was the policy's internal mechanism, its internal savings account, to keep the policy alive and funded during your later high-risk years. Once the policy fulfills its ultimate purpose by paying the death benefit, that reserve mechanism is no longer needed, and the insurer retains it as compensation for having carried that mortality risk for so many years.
Okay, let's move to accessibility. What about people who either can't, or maybe just prefer not to, go through that traditional rigorous underwriting process with the blood tests, the urine samples, the EKG reviews we talked about earlier?
This is where non-medical underwriting comes into play. The first option is simplified issue insurance. This offers a scaled-back, much faster underwriting path.
And what's the primary difference in that process?
The key trade-off you make for speed is limited face amounts. The coverage amounts are typically capped, often somewhere between $250,000 and $500,000, which is lower than you could get with a traditional policy.
And the requirements?
They generally do not require a medical exam. Instead, they rely very heavily on electronic database, checks prescription drug databases, your motor vehicle records, and a very detailed application questionnaire about your recent medical history.
So if you have a non-life-threatening chronic condition, say mild asthma, that might just slow down a full medical exam process, simplified issue could be a really efficient way to get covered.
Exactly. It appeals to people who need coverage quickly or who have minor health issues that might result in an immediate substandard rating under full underwriting. Approval can often happen in just a few days, not weeks.
Okay, now let's look at the absolute lowest barrier to entry, which of course carries the highest premium and the greatest risk for the insurer.
And that's guaranteed issue insurance.
Guaranteed issue is the ultimate non-medical policy. Approval is guaranteed for pretty much everyone, regardless of their health status, as long as they're within a specific age range, often 50 to 80. They ask zero medical questions.
None whatsoever.
So if the risk pool is completely unknown, the premiums have to compensate for that uncertainty. What are the trade-offs?
The trade-offs are significant. First, coverage amounts are the absolute lowest, frequently maxing out at just $25,000 or $50,000. It's really just enough to cover final expenses. And critically, The premiums will be considerably higher than even the substandard rates on a fully underwritten policy. This product is really the only option for certain demographics, like older applicants with multiple severe, uninsurable conditions.
Now, since the insurer knows that people who are very ill are the most likely to buy these policies, they have to implement a massive safeguard against what's called anti-selection,
They do, and that's the waiting period trap.
the waiting period.
This is the mandatory mechanism that keeps guaranteed issue financially viable for the company. These policies always have an initial waiting period, which is typically 2 years before the full death benefit is paid out for a natural death.
So what happens if the insured person dies from an illness during that initial exclusion period?
If the death occurs within those first 2 years, the beneficiaries do not receive the full face amount. Instead, the company will typically just return all the cumulative premiums that were paid, plus a small amount of interest, maybe 7% or 10%.
This removes the incentive for someone who is near death to just immediately buy a policy days before a claim.
It does. Now, once that 2-year waiting period is satisfied, the full death benefit is paid out, regardless of the cause of death, as long as the premiums are current.
So it's vital for you, the consumer of guaranteed issue, to understand that for those first 2 years, it functions more like a short-term savings account for final expenses, not true insurance coverage.
That's a perfect way to think about it.
To wrap up our deep dive, let's cover the critical legal and financial environment where all these term policies operate. First, and this is the best news for beneficiaries, the income tax implications.
This is the single greatest immediate financial advantage of life insurance. Under U.S. Income Tax Section 10(d), the lump sum death benefit that your beneficiary receives under a term life policy is not subject to federal income tax.
So a $1 million payout is received 100% tax-free by the recipient. It doesn't impact their adjusted gross income for that year at all.
Not at all. It completely bypasses income tax. However, we do have to clarify the caveat.
Okay.
There are 2 potential tax liabilities. First, any interest that the beneficiary earns on that money after it's been paid out and they've invested it, that interest is taxable.
Of course. And second, there's the estate tax issue. Now, this only applies to very large estates, but it's a crucial detail for our well-informed listener.
It is. If you, the insured individual, legally own a policy with a massive death benefit, say $10 million, the value of that death benefit is added to the total value of your taxable estate.
And if your estate exceeds the federal exemption limit,
That death benefit may be subject to estate taxes, which can significantly reduce the amount that your heirs actually receive.
so how do high net worth individuals structure their term or permanent policies to keep that death benefit outside of their taxable estate?
They use a very sophisticated tool. It's called an irrevocable life insurance trust, or an ILIT.
An ILIT.
By setting up this trust and having the trust be the official owner and the beneficiary of the policy proceeds bypass the insured individual's estate entirely. When the death benefit is paid to the trust, it's often exempt from estate tax, ensuring the full amount goes to the heirs, often tax-free. This level of planning is absolutely essential when you're dealing with multi-million-dollar policies.
That detail is exactly the kind of synthesis we want to provide in a deep dive. Okay, finally, let's address the difficult but necessary standard provision that's in every single policy, the suicide clause.
Every individual life insurance policy contains this clause. It's primarily a protection mechanism for the insurer against anti-selection, and it's usually mandated by state law.
And what's the standard rule?
Most state laws require carriers to make a payment for a suicidal death, but only if it happens past 2 years of coverage.
That 2-year window is critical. It's what's known as the contestable period. The company can investigate the claim and potentially deny it based on non-disclosure.
And this is where the sources stress a point that is so crucial for you as a policy owner during the underwriting process. Disclosure is key. If you, as an applicant, are currently using antidepressant medication, or you have a history of mental health treatment, you must disclose it during the physical exam and the interview.
Why is that honesty so important, even if it might mean you get a slightly higher premium?
Because if the company discovers you misrepresented your health, that you failed to disclose a history of severe depression, for instance, and the insured commits suicide within that initial 2-year exclusion period, the claim could be denied entirely due to material misrepresentation.
Whereas if you disclose the condition,
You might get a substandard rating, but the company knowingly accepts the risk, and so the claim is protected once that 2-year clause is satisfied.
and what's the financial outcome if the suicide does occur within that exclusion period and the policy isn't covered?
The beneficiary is almost universally owed a return of the premiums paid. But no death benefit is paid. The company just refunds the money that was paid in, but the primary purpose of the insurance is not fulfilled.
Okay. We have really dissected term life insurance, from the annual risk structure of RT to the complex averaging of level term pricing and those crucial conversion and tax planning features.
I think the essential takeaways for you, the learner, should be synthesized into 3 points. First, term life is a strategic, pure risk transfer product. It is temporary, cost-effective coverage designed to protect your human income during your years of peak financial responsibility.
Second, that predictability of a level term premium is, in a way, an illusion. It's created by actuarial science. It's an average that leverages the time value of money to pre-fund future exponentially higher mortality costs. And it's all governed by those 3 universal assumptions: mortality, investment return, and administrative expenses.
And third, the conversion right is your most important long-term safeguard. You have to understand its deadlines and use it to lock in your original favorable underwriting status if your health ever deteriorates, even if the eventual converted policy is expensive because of your advanced age.
This entire discussion, everything we've talked about with term insurance, whether you're analyzing the premium curve or the strategy behind buying it, it all fundamentally boils down to a question of time.
And what's so fascinating here is the dual nature of that wager. Term insurance is a calculated bet on time. It is the company's bet on how long you will live based on all their actuarial tables. But simultaneously, it is your bet on how long you will need that external financial protection before your own accumulated capital allows you to achieve true self-insurance.
It's a dynamic tool.
It's a dynamic tool used intelligently to bridge that gap between financial responsibility and financial independence. So the real strategic question for you to mull over isn't just how much coverage you need, but precisely when that need will end.